The theme of this quarter's forecasts is very apt, I think. We've called it under the pump because that really does kind of categorise what's happened to the New Zealand economy, actually the global economy to some extent. In the last few months with the onset of this Iran war, we went from the start of the year having a fairly constructive view about how the New Zealand economy was going to go this year. We basically thought that a lot of the pieces were in place for a year where we could expect a year of solidly positive above trend growth, falling unemployment, and finally the recovery that we've been probably waiting for a couple of years now, I suppose. Hopefully in the context of inflation that was going to be pretty close to 2%. But that all really changed quite rapidly when we got, probably only a couple of weeks after we published our forecast. That's sod's law for you. But then Donald Trump and Israel did what probably every geopolitical advisor would have suggested not to do, which is start invading the Middle East and in particular attacking Iran. And Iran has responded in the way that you would expect and would be widely predicted to do, where they basically responded by closing the Straits of Hormuz, attacking their neighbours, attacking 20-odd% of the world's oil supply, and doing it in ways that have been surprisingly effective because we're over 95 days, I think, into this now with the Straits of Hormuz closed. And really in the midst of quite a severe global supply shock for energy, not just in kind of oil and refined fuels, but also critically in natural gas as well, which is really having quite a big impact on the markets, on the economies, and has basically got that New Zealand economy under the pump. So I'm going to take you through, firstly, what all this means from our perspective for the global outlook, and then we'll talk about how that's translating through to what's going to happen in New Zealand from a growth and inflation perspective. Then I've got a little bit of a sectoral breakdown because it is one of these things where this sort of shock and indeed the fortunes of the New Zealand economy, it is not the same for all sectors or all bits of it as well. There are bits of it that are probably going to be relatively resilient, but also other bits that are really going to be under the pump. So we'll talk a little bit about that and talk a little bit about risks as well, because there are many risks sitting in this outlook now to think about, whether it be the progression of the war or the fact that we've got an election coming at the end of the year. And then my colleague Imre is going to talk about, well, based off all of this, what's going to happen to financial market prices in the short term as well. I'll be certainly sitting on the edge of my seat to see what's going to happen there. All right, globally, what's happened? Well, as I mentioned, big issue. The unthinkable has happened and has been happening for 95 days. The Straits of Hormuz, spectacularly closed late February, basically has brought shipping through the Straits essentially to a halt. And that's what the red line on this chart shows. It basically shows the daily numbers of total ships go through that strait, and it's gone from sort of 100, 120 a day to not zero, but something pretty close to zero. There is a bit of debate about whether there are ghost ships sailing quietly through the Straits of Hormuz and supplying the world with oil. There might be the odd ghost ship. There's your amount of smuggling and sanctions busting going on out there. But in the end, it isn't. Most experts would argue that it doesn't really come to very much. So it's essentially 20 to 25% part of global oil supplies and gas supplies has been curtailed for quite a long period of time. There have been some workarounds around this, such that some of the GCC countries have been able to reorientate some of that supply through other routes. They've been able to use overland pipelines. There's been a bit more oil supply and gas supply being able to go through the Red Sea, for example. Not really enough to compensate for what's kind of like happened here, but the net upshot of it is we're probably down 10 or 15% of global supplies basically, and have been for a while. And that long period of time that this is happening is a source of accumulating pressure on the economy. And indeed, at the start of March, when I was starting to talk about this stuff, we were talking about scenarios that suggest that, maybe this would come right in a few weeks or a month. I thought we were pushing the boat out there to kind of do a scenario about what happens if it happens to 3 months, and that had some pretty serious implications for global and New Zealand growth and inflation. When we ran that through the the global economic model that we kind of like use to analyse these things. And then, I'm going to show you a scenario later which says, well, what happens if it stays for 6 months, which is we're halfway there now, and that have even more serious scenarios. It's turned out that, like just about every war that I think the world has been involved in for the last 100 odd years, the refrain is usually, don't worry, it'll be all over by Christmas. And it's never over by Christmas. And I would wager actually this won't be over by our Christmas either, which was obviously going to have some implications as we go forward. Probably the biggest, most noticeable implication you would have seen is in your petrol price and the oil price. This is a long-term chart of global oil prices in real, i.e. inflation adjusted as well as nominal terms. In inflation adjusted terms, these oil prices have gotten up to levels at times that have been certainly consistent with global recession in the past. There's been quite a lot of volatility in the last month or so, and to some extent, some of these prices have come off their highs as the most active shooting part of the war has gone on hiatus. But nevertheless, as you can tell from the previous chart, there hasn't actually been an improvement in supply conditions. And the saving grace here, I think, is that, whereas in the 1970s, we had the big oil shock, which really did shake the global economy right to its core. Here, it's had a big impact, but nowhere near as big because we don't use oil and gas as intensively as we did back then. We use it a bit more efficiently, so we can get the impact on output has not been as significant. It's meant that we've had a bit more breathing space to those relative to those terrible experiences that probably your parents or grandparents would have told you happened to New Zealand back in the 70s, which is probably the closest analogue to what we've had today, actually. And I don't think that's exaggerating very much, actually. Like this shock to global oil supply is totally in the 1974 oil crisis type scenarios. My first question of the day, though, is that in light of that perhaps relatively unsettling story that I might have just told you there, if you're thinking ahead in terms of what kind of fuel price scenario you're planning around if you're thinking about managing your business, like which of these options sound kind of closer to the mark in terms of what you're planning for? You think that fuel prices are going to rise to new highs and only fall really slowly in 2027? Do you reckon that they're just going to come back quite quickly? Donald Trump's world peace is going to break out. He's going to organise it. We'll be building statues to Donald Trump in every town. And by the end of this year, petrol will be back where it was. Diesel will be back where it was. Do you think actually maybe that doesn't go up that much, but it's going to be more like early 2027 where we see a lot of progress? Or is it going to take kind of like more like the later end of next year before we see that happen? Or actually, do you think that the supply is going to come back really fast, the demand's going to come off such that, we get really low oil prices and fuel prices in 2027 sometimes? Let us know what you think, and then after that I can tell you what we're assuming. All right, so look like we're stabilising a little bit in the 30s here. So what do we got? So fuel prices don't fall significantly until early next year. Seems to be or maybe middle of next year, depending on what happens. Yes, I see relatively little optimism in these answers. Even the third option of going back to new highs before they come down very slowly seems to be the next best option, which I don't think is wrong, actually. I think there are good reasons to not be very optimistic here about what happens. So let me talk to you about why we're thinking about this. Now, the first thing I'll say is that these are our assumptions that we have around what oil and refined fuel prices will do for New Zealand in the next while. And a couple of things I want to point out here. Firstly, oil price has gone up a long way, but refined fuel prices have gone up by more. So what has tended to happen here with this shock is that because the feedstock, the crude oil that goes into these refineries has been constrained, it has led to downstream constraints on the ability of the refiners to supply all the demand that's out there. And also this increased uncertainty has meant that many people have decided to hold a little bit more refined fuel in stock than they would normally do so because they don't really know what happens. Look at our own government, for example, right? We've just cleaned out a tank in Marsden Point to get another 9 days. in the tank. We're not the only people in the world thinking that way around. So the effect of that has been to mean that the price that the economy really faces here, it's not crude oil, because we don't have an oil refinery anymore. We don't have any need for crude oil. We actually just import the refined product from Singapore and Korea. And that price has really gone up relatively strongly. And that's why you saw the petrol price and the diesel price rise really steeply through March. You've seen it probably come down quite noticeably through April and particularly through May as some of the uncertainty reduced in the market because the shooting war stopped. But we expect that even though oil prices might return to the pre-conflict level in the middle of 2027, I think it'll take longer before you see the refined fuels prices really fall that quickly. Partially because people have noticed that this is a bit of a vulnerability in their supply chain, right? Like, put your hand up if you think it's a cool strategy to just rely on the Middle East for all of your diesel and fuel needs. You know, like, I don't see any hands up. Chris, any interest? No? No, I think people have recognised the value of insurance here, right? And that's going to mean that there will be demand to replenish inventories, to diversify away from the Middle East to a secure fuel, and that will come at a higher cost than what was previously the case because those Middle Eastern suppliers had historically the lowest marginal cost producers. The UAE, for example, was one of the lowest in the world. It's probably not right to assume that oil's going to remain or petrol is going to remain at these sort of levels forever, but there are scenarios where that could absolutely happen because ultimately the world will adjust to this. There'll be a combination of new supply that is brought online and demand will be destroyed because the price will go up and people won't be able to afford it. So the idea that you have a downward sloping assumption for energy prices over the medium term makes a lot of sense. I think there's quite a lot of uncertainty about exactly what happens between now and the medium term though. And, you know, like the potential here that we actually do see sharply higher prices before you see them go down is a very reasonable scenario to kind of have in mind, even though you may feel quite comforted by the last few weeks of seeing these prices go on and perhaps be thinking that things are coming right. And, you know, that first chart I showed you, which suggests that the only thing going through the Straits of Hormuz at the moment is seagulls going left to right. Certainly not gas tankers and crude oil tankers, suggests that what's really going on here is we're eating into the buffers that we have around the world. And when you do that, as with any buffer, you're exposed to more risk, basically. You may find one day you wake up in the morning and you hear about a coup in Suriname or a storm in Korea. And then the next news story is about the fact that we've cancelled a few fuel shipments coming in from Asia because they can't satisfy it. Sort of things that normally would be on page 7 of the newspaper as an interesting story to read will become a lot more prevalent and important to our day-to-day if these things happen. And in this market, it happens all of the time, because all the oil and gas that comes in the world typically comes from the most unsavoury and unstable jurisdictions that you can find. So what's this meant for our global growth outlook? Well, it's been cut. It's been cut decently. I wouldn't say like hugely, but where the cuts have come is quite interesting, is that this shock is disproportionately impacting our Asian trading partners. And the reason for that is that those are large industrialised economies that were getting, you know, upwards of 40 to 70% of their crude oil and natural gas from the Middle East before this came. So they're really in a lot of trouble, and we're in a lot of trouble by implication because we're just a bit further down the chain from them. So we take the hit in terms of higher costs, but we're also getting the hit in terms of weaker trading partner growth expectations coming from those. Interesting story, actually. China is a good one, where the Chinese economy started to look a little bit ropier recently. The authorities like to type 5% growth in as for what they do for GDP. I think they may have already decided what 2026 GDP is going to be. I think they might have decided at a meeting 2 months ago. But they're having to rethink that. And part of the reason is that with this oil price having gone up, they've had to significantly curtail their oil imports. And that's been a double-edged sword. On one hand, what it has meant is that the people we buy fuel from have not had to compete as aggressively against China for the fuel that we need. But but also inside China. It means they're running down their buffers and it's having impacts on the industrial sector up there as well, and therefore their growth. The US is also an area where things are a little bit weaker, but actually not as weak as most other parts of the world because the US is an energy exporter. And this is another reason why, you know, whilst you might think here that the most pressing issue of interest to the American voter right now should be the closure of Straits of Hormuz, you will find that that's not really the case. If you have a look in the newspapers in the States, or if you read the political digests, they're much more focused on internal issues up there because actually for a lot of the US, particularly the Republican bit of it down in the South, which is where Trump's base comes from, they're actually positively affected by higher energy prices because that's where the US energy sector is concentrated. So this shock is actually giving the US president time to be able to kind of like try to do what he wants to try to do with the Iranians. He may need a lot of time, I suspect, to achieve what he wants. But it does mean that it's a much more pressing issue for places like New Zealand, Australia, Asia, Europe, than it is for the United States. Things are not all bad out there in the global economy right now. I mean, one thing I didn't have on my bingo card when I started to think about, well, how is the shock going to impact on New Zealand and the world back in March, is I would have expected that in line with most geopolitical stress shocks that you would assume, is that asset prices would be quite negatively impacted by this shock. But actually, that's not what's happened. I mean, I would have thought it would be much more likely that equity markets would be 10 or 15% lower by now, but actually they're probably more like 15 or 20% higher. Credit markets are really strong right now. Credit spreads are really, really narrow. I mean, people can get money easy enough. So that kind of credit channel is not really kind of like working as intended. And the reason for that is that corporate profitability out there, particularly in the United States, but in all of the countries that have supply chains related to the AI boom that's going on out there, these companies are making a lot of money at the moment because there's more than one thing going on. Yes, there's an oil shock that's really impacting on the industrial sector, and that may come for the IT sector eventually because you need a bit of gas, a bit of helium to be able to make a computer chip. But for now, these firms are making a lot of money. So if we look at, here's a quantitative estimate of what's been going on in terms of the impact of output in the United States. This red line here is US investment in basically all of the stuff that goes into data centers and in the AI industry. Look how steep that red line is moving up. It's moving up faster than when computers were born back in the 50s and 60s. It's moving up faster than it did during the dot-com bubble, where all sorts of silly stuff was happening in the kind of IT sector and generated quite a lot of activity. And if you remember, well, you may not remember, but I saw a very interesting video of a very excited Jensen Huang, who's the CEO of NVIDIA, who is the guy in charge of the firm that seems to make the chips that AI operates on right now. He was very excited and he described his business demand, the demand for his products, as parabolic right now. And certainly if you look at that kind of red line, you can see what he means, right? These firms are making a poultice right now and they are investing like crazy. And that is an important offset to what is going on out there in the world. Now, I'm not going to promise you that this is going to go on forever, but it is probably reasonable to think that there is something fairly transformational going on out there in the world with respect to the integration of IT into firms' production processes. I would argue a lot of firms have probably barely scratched the surface in terms of their investment in this stuff. So it may go on for a while, unless, of course, the grim reaper of helium supply means that you can't get many computer chips in the next 6 to 9 months or so, and I can tell you that it's very hard to run a data centre on an abacus. Underlying message there, bad stuff happening, like last year when tariffs came, but also good stuff also happening as well. So things could be a lot worse and have been unexpectedly better than feared. So if I think about how that's translating through to New Zealand, well, we've had to cut quite a bit out of the growth outlook. We're on a 1.5% growth rate forecast now for 2026. And at the start of the year, I was talking about 3.5 as being something a lot more likely. And, you know, the sort of real big impact here has been, of course, you've noticed the higher fuel prices. That's impacting on business and consumer spending. But the uncertainty, I think, is the biggest thing that's really impacted on this economy so far. Now, right now, I don't think anything particularly bad has really happened to many people at the moment. I mean, looking at the high frequency data, I've got a bit more detail on that later. It doesn't look like a lot of people getting fired. You know, some parts of the economy actually came into the shock doing very well. The manufacturing sector, the tourism sector, for example, had very strong starts to the year. It really did look like, running up until March, that this year was really primed for a year, quite strong growth. But this shock has probably put it on hiatus for at least a quarter, possibly two. So we're forecasting that GDP will actually fall back in the second quarter, which we're sitting in now. We'll get that data September sometimes. Very helpful. And, you know, probably be still quite weak through the third and the fourth quarters before, if that assumption we've got about oil prices coming down by the end of the year and into next year comes right, then we should be back to more normal service. And for next year, for example, we have just under 3% growth forecasts, a little bit stronger for the year after that. So this is a picture of growth delayed, not cancelled, recovery delayed, not cancelled. And you probably heard that message, I think, from the Minister of Finance last week when she was talking about the budget as well. I think it's probably a reasonable view, but heavily contingent on that energy price assumption, that geopolitical assumption that we've got in there, which may or may not be too optimistic, to be honest with you. If we look at that growth profile and translate it through to what's happening in the labour market, we would anticipate that instead of having a year where the unemployment rate would top out in the mid-fives and be lower, noticeably lower by the end of the year, it's one where we actually don't think that's going to happen. We think the unemployment rate probably tick up a bit, go up something more like about 5.6%, and still end the year well over 5%. So that's a pretty disappointing outcome, I think. You know, most of us would have been hoping for a better labour market than that in 2026. But that is probably the big impact that this big shock is going to have on that labour market, really delaying the labour market recovery. And for inflation, well, you probably noticed that a bit. There's a bit of inflation out there. We actually, unfortunately, came into this shock with inflation that was too high. March quarter CPI registered 3.1%, which is a bit higher than what people were expecting at the time. But, you know, based off what we can see is going on with things like fuel and airfares, a whole lot of other products, food, we would anticipate that headline inflation will be comfortably over 4% on an annual basis for the balance of this year. And that's a world of difference away from what we were thinking last year, where, you know, the view was that inflation would probably be somewhere around the 2.3, 2.2% level by the second half of this year. That doesn't seem very likely now. We do expect to see sharply lower inflation in the future. Part of that is coming from the fact that we do assume that oil price to fall back. So some of that inflation we're getting this year will unwind. All those fuel surcharges will come off. That's why the red line for the headline CPI has a pretty big cycle in here. I would be a bit cautious about betting the farm on that cycle right now, because it basically is a derivative of what you assume for oil prices. And we can put your own assumption in for that, because you can get quite different numbers. But core inflation is expected to move noticeably above 3% instead of hitting, you know, well into the low twos, and only gradually fall through 2027 and 2028. And that's a picture that means that the Reserve Bank will be looking to raise interest rates. They actually fired a shot over the bow a week or so ago when we had a surprisingly tight split vote there. Half the MPC wanted to raise rates last week. I don't think that would have been a bad call, to be honest with you. But then the internal MPC members decided, no, we need a bit more information on exactly what core inflation is going to do here. But they all agree that certainly by the end of this year, interest rates are going to be higher. Probably closer to sort of 3%, I would say, is what they've really got in mind. The question is, when do they get started? When do they have enough evidence that those building core inflation pressures are going to be translating through the economy to get things moving? And basically getting interest rates back closer to sort of where they think the neutral OCR is now, and that looks like it's probably around about 3.25% now. Now, my view here is that, you know, the Reserve Bank has a tendency to undercook its medium-term forecasts of things. It's a little bit artificial how this thing work. My sense is that what will happen here is it's going to be a bit more of a struggle to get inflation to come back to 2% after all of this. And it will require a period of above neutral interest rates to really bring that inflation rate back down to 2%. So we've got a forecast sitting in there where we go up 4.25% by the end of next year, stay there for a year, and then head down to 3.75%. 3.75% is the standard assumption I've been making about where the neutral OCR is in this economy. Very much, I think one thing to keep in mind here is that we are in a rising global interest rate world now. So we had a period between the GFC and COVID where inflation was really sanguine, interest rates were constantly falling very low. Some parts of the world, like the ECB, had negative interest rates for most of that period. We had interest rates that were very low, somewhere between 2 going into COVID, where they went down to 0.25%. The current market's conditions would tell you that the world is really preparing itself for a period of 4 to 5% interest rates over the medium term in most jurisdictions. And I don't think New Zealand will be immune to that. So the idea that you see a forecast of interest rates in New Zealand heading up towards 4, I don't think should surprise you very much. And if you look across the ditch in Australia, you can see they've already got interest rates in the mid-4s and forecasted to have them close to 5% before the end of this year. That is kind of the reality that we're in now. There's tons of uncertainty though out there. These are a slide I put together that just showed the Reserve Bank scenarios for, if things go well and if things don't go so well. Basically, it gives you an insight on what they're really worried about here. 2 of the scenarios were around the idea that oil prices remain a lot higher than they're kind of forecasting, and also that inflation expectations, pricing behaviour becomes embedded such that it is actually quite hard to get inflation down. Now, my favourite anecdote of the week right now is last week I went to get my benchmark cup of coffee from the place across the road at work. Put it up by $1, 22.5%. That price rose for that cup of coffee. There is not much Qatari gas in my cup of coffee in the morning. It doesn't even have any milk in it, so it's not the dairy prices that did it. But what happened there is that firm, they probably noticed rising cost pressures for a while now, and they took the opportunity to put my price up. And I don't think it's going to go down when the oil price falls. And that's the sort of behaviour, I think, that is kind of implicit in some of these scenarios where inflation goes higher, stays there for longer, and you have to do more with interest rates to bring it back down again. I think it's a very reasonable concern to have in mind, even though we have no particular evidence beyond my cup of coffee that that is happening now. But on the other side of the thing, there's parts of the MPC that are really worried about just how high the unemployment rate's going to be and stay for a while. And the idea that the economy is sufficiently weak, though, even though there is this big increase in cost pressures out there in the economy, that firms will not be able to pass it on. Their weakness in the economy will be sufficient to mean that inflation passes through the system quite quickly, and therefore interest rates don't have to go anywhere for 2.5 years or so. You could obviously drive a truck through those scenarios. So what they're really telling you is that we could do anything in the next year or so. Their signal is that on balance, they think they're going to have to take it up towards 3.75%. But what we learn about how the economy behaves in the next 6 to 9 months will be critical in determining which of these lines we end up finding ourselves going along. My bet is we're probably going on a line that's a lot closer to that black line for the interest rate at the top, compared to the really, really flat one at the bottom. But reasonable people will disagree on that. So getting into the sort of like the guts of sort of how different bits of the economy are going to be impacted, I've got another question for you. So based off how you see the outlook right now, what actions are you taking in your own business to manage the consequences of the Iran war on the operating environment? And you can pick a couple of options here, if you'd like. Choose your top 2. That way I can kind of, people have got the opportunity to pick a couple of things that are most relevant to you. I mean, are you just keeping a watching brief? Is it just a bit early to tell what you should do? Are you reviewing your prices because your margins are getting squeezed too much, basically, by the increase in costs? Are you a bit worried about your staff, your skilled staff leaving? Reviewing prices. It's not good news for the Reserve Bank, is it? Too early to tell? reasonable perspective because there is a lot of stuff going on here. We don't know how long this is going to last. Postponing investment. Nobody's raising staff compensation, Chris. That's interesting. I did a presentation with this question last week, and actually the same two there was just a different order, basically. I think more people said that it was too early to tell, really, before they're making decisions. But the next big one was the need to review prices because there has been some significant cost increases come through. So if we have a think about the sectors, the area of strength, I think, in this economy in the last 2 years, really, I suppose, is the agricultural sector. They've been enjoying very strong returns in their markets. We saw, for example, Fonterra farmers got a very big cash injection in April when that was sold off. But the milk price generally has been sitting up there and above $10, and currently we're forecasting it to be $9.50 for the coming season. Fonterra is telling people $9.75. These are really strong returns. And even outside that, there's very strong returns for meat right now. The demand for protein out there in the world is very strong, and we've been in a really good position to be able to satisfy that. Even wool producers are doing pretty well now. For some reason, there's a big increase in wool demand. So basically, even though people's costs are increasing in this sector, and that is impacting on what we call the terms of trade, because our export prices are expected to hold up quite well, but our import costs, and the biggest import costs you could probably think about is those higher oil and refined fuels prices. That's gone up as well. So that's basically reduced our terms of trade a bit. But it's not a very big hit compared to previous cycles, and it's expected to bounce back and remain relatively robust over the medium term. I noticed the government had some similar, actually even more optimistic forecasts in their budget forecasts around this sort of like assumption. So we have had a big income shock here to the economy. It's not as bad for the agricultural sector because they've got the good, strong returns that we should expect them to reasonably be able to earn. The cost has really come through because, we imported about $10 billion of refined fuel last year. And, the cost of that's up probably 50, 60% now, I suppose. So that's another $5 or $6 billion the country has to find to be able to cover that cost. And that's basically come straight off our bottom line, right? It's less income for businesses, it's less income for households, and it's the main reason why what we call a negative supply shock or a negative terms of trade shock really impacts on the economy. One of the other areas of cost that's kind of like impacted in there on the agricultural sector is fertiliser. Costs have risen quite significantly because quite a lot of global fertiliser supply either came from the Middle East or it relied on oil products that were coming out of there. This is something that is going to be particularly important for non-New Zealand agricultural producers because we're lucky in New Zealand. Farmers here are used to basically not using fertiliser for a year if it's gotten too expensive, or if they haven't got enough money, because we have good growing conditions here. We can still grow stuff even if you don't put the fert on every year. But in a lot of other parts of the world, if they don't have fertiliser, they can't grow anything. And that is the situation that our farmers are going to be in this year, where, luckily enough, we did actually get a bit of fert in before the straits closed, so we're good for probably 6 months. But the rest of the world is sitting there short. They probably can't really afford the prices that it costs to buy what's available. There will be a reduction in global agricultural production as a result of this. That will reduce the supply of food out there in the world, and we will probably be relatively well placed to meet the demand that will still be there. And that's kind of an important reason for why I remain optimistic that actually from an income perspective in the agricultural sector we'll do all right out of the shock, even though farm input expenses in aggregate rising much more strongly because fuel prices are going up, as well as those urea prices as well. It's also a reason why, if I look around the country, the sort of outperformance I've tended to see in the bits of the country that are more tightly orientated to agriculture should continue. So anywhere in the South Island, south of about Nelson, I think is a really good example. Like you go to Christchurch now, it's like going to a different country. I would recommend people from Wellington to visit Christchurch, perhaps just to cheer yourself up a bit. You'll see people going out for dinner on a Tuesday night. You'll see people going to work. You will see things getting built, things that perhaps you have not seen in this part of the country for quite some time. And, you know, whereas in places like Auckland and Wellington, it's pretty tough, isn't it? Because we're service sector economies. We're basically the ones that are bearing the brunt of that big increase in energy costs that's coming off our budgets, that are basically reducing the disposable income that we have to spend. And therefore we cut back on stuff like, for example, going out, spending on housing, etc. And it's being reflected in much stronger growth in jobs out there in the regions compared to in the major urban areas. And indeed, you know, as I'll show you in a couple of other charts, there's plenty of other indications of that outperformance, which I think will continue as we go through the balance of this year. Houses are a good example. Wellington and Auckland house prices going down. Southland house prices are higher than they were at the peak during the COVID boom. Canterbury also quite strong. And that is just reflecting that kind of like strength in the incomes in those parts of the country. And it does tell you that this economy isn't actually fundamentally broken here. It's just that the fundamentals are much better in parts of it than it is in other parts. It's also consistent, though, with our idea that nationally, I don't expect to see house price growth this year. I think probably it's more likely that house prices will fall about 1% or so. That's consistent with there being about a 1.5% growth rate, which is what we're forecasting. This is just a simple scatter plot of the annual growth rate in GDP versus the annual growth rate in house prices. So it all sort of lines up there. But I expect there will be significant regional differences, where probably those parts of the country where the income growth and the employment growth and population growth is stronger will do better. And then other parts of the country, probably like Auckland and Wellington, will end up be dragging the national average down. So thinking about the consumer, I've told you before, consumers, two things have happened to them. One is they've had a big negative income shock here because we're paying more for our fuel. But the big thing I think has also impacted in them is uncertainty as well, because we don't quite know what's going to happen to us next. This chart here shows one of the consequences of this big shock is to result in a reasonably significant lift in household inflation expectations. People have noticed the prices have gone up. You can also see quite a lot of volatility there. Things got a lot better in May than they were back in April, and that's simply because the petrol price went down in May. So you can't extrapolate too much, I think, from some of these trends. But what we do tend to see is that when household inflation expectations rise, consumer confidence falls because consumers don't think that they're probably going to be compensated for the inflation shock that they're facing. So you're sort of seeing a little bit of the inverse kind of like pattern that you see in consumer confidence as we see inflation expectations. But in general, consumer confidence is a ton weaker than it was at the start of the year. And as a result, that's one of the reasons why we don't expect much out of consumer spending for the next couple of quarters or so. Some of the earliest data that we've got available is our card spending data. I think we're going to get the May month actually later this week, I think Satish told me. And what you can kind of see here is that aggregate spending, that's the small bar at the top, that's basically flat in the last couple of months. But we've really had to change what we're spending money on. So we're spending a lot more on fuel, that big increase in the bar, a bit more on groceries as well, because we've perhaps not been going out quite as much as what we might do. And we've been cutting back on the nice to haves, and travel in particular is one of those categories, which looks like it's been relatively weak right now. And you would have seen the stories going through in New Zealand, cutting capacity, raising prices. That's them responding to this new operating environment. The other thing that we're nervous about is tourism, because we think this could be something that is going to get hit. And the reason is jet fuel prices have gone through the roof for the same reason that Straits of Hormuz is closed. And that's put a lot of upward pressure on airfares. And that means that for a lot of people coming to New Zealand, it's a big trip, right? You've usually got to sit on a plane for 10 hours or so to get here. It's expensive, and it's got a lot more expensive. There's also quite a lot of uncertainty out there in the world as well. We are expecting that we will see a hit to our tourism sector coming from this shock. And we are seeing some signs of that, where arrivals of non-New Zealanders looks like it is dropping back in the last few months. It remains to be seen just how well that sector goes. Reasons to be optimistic. Some of the recent stories I heard from one of the customers was that demand out of Australia and Asia may be proving to be a bit more resilient than hoped, but demand out of North America and Europe is not doing too well. So we have to keep a watching brief on that. Basically, we've taken the view, though, at least in the short term, that this is going to take a bit of a step back before it steps forward. For businesses, well, their biggest beef is, well, firstly, business confidence is plummeted. That's, I don't think, probably a pretty reasonable turn. Based off the business confidence surveys, you would say confidence is probably close to as weak as it was during some of the lockdowns, and certainly as weak as it was in mid-2024 when we had a couple of quite weak quarters of negative GDP growth. GDP fell kind of around 1% a quarter through that period. Businesses' confidence has declined predictably because the costs have risen. They're uncertain about how much they're going to be able to pass that through into prices, so the implications for their margins are quite weak as well. And as a result, it's having that kind of impact on confidence. And we would expect that to be reflected with a lag with their investment decisions. So I noticed in the answer to that question you gave earlier, there was a few people there voting for the idea that you should curtail investment for a bit while you see what goes on, and also potentially employment as well. The good news, at least up until the most recent data we have available, is we don't really see strong signs that a lot of people are getting laid off here yet. This is the filled jobs number that we get from basically IRD, and basically tally up the number of people that are getting paid every week. We get this data with about a 3-week lag or something like that. That red line, thick line there that stops kind of like around about week 17. What you can see there is that right now the total number of employed is about the same as it was a couple of months ago. And it isn't really falling very much through the middle of the year. And I guess my concern is that that may start falling if this crisis goes on for too much longer, in which case you'll get that higher unemployment rate that we're forecasting. But right now, so far, not happening too much. Next few months, what happens, I think, will be quite key to see what happens there. So risks, plenty of those. As I advertised at the start, we've been 95 days into this now, which is a long time. I was asked actually by the risk people in the bank to talk about, well, what happens if this goes on for 6 months? If we're sort of like still in this position, perhaps getting closer to Christmas. And what this does, if we model this through our global economic model, is it has a significant depressing impact on global growth. Energy prices have to rise really significantly. We'll probably see oil price go back over $150 a barrel. You'll get much higher inflation out of it. So that's inflation heading up well over 6. You'll see the unemployment rate head up towards 6%. And you'll see much weaker house price growth. Basically, house price falls closer to about 5% per annum instead of the 1% per annum we've got in the forecast now. So that's a pretty unsavoury scenario, really, in terms of what the risks are. It's probably best to kind of view those scenarios as directional only. We've already been pleasantly surprised at how well we did. Now we're at day 95 compared to where we thought we would have been back in March. But, there's a lot of moving parts here, and it's pretty hard to concoct a story that if this goes on for another 3 or 4 months, that this is going to be a great news story for the economy. And that's why there's quite wide confidence intervals right now in terms of what the economy does. And the last thing I'll leave you with is the other key source of risk this year is the election coming in November. I don't know who's going to win the election, but I can tell that it's going to be quite close. And it does rather look like New Zealand First might end up holding the keys for deciding who's actually going to be in charge. What we can see, though, is that voters have got some pretty big choices to make in terms of what we get out of government policy looking forward. Like National, the coalition is presenting itself as a strong fiscal manager, basically looking to maintain a very tight fiscal line over the next few years, bring debt down. Significant public service cuts, for example, were in the forecasts, and potentially looking at superannuation reforms to be able to kind of like improve the medium-term to long-term debt trajectory of the economy. On the other hand, Labor, they've been talking about a capital gains tax. There's actually probably quite a lot more policy that they've got to come out. I would have thought it would be very plausible under a left-leaning government that we might see more action in the forms of more taxation as well as more spending, potentially more borrowing to finance investment projects or other needy projects, and also the potential for minimum wage rises as well that could happen in an effort to kind of try to get people to catch up a little bit for what they lost in spending power in the last couple of years or so. And, you know, some of those things are obviously, a lot of those things are potentially quite different for business, depending on which size it is. Also quite important for the Reserve Bank as well. Things like minimum wage rises, for example, were one of the things that we think really juiced inflation in the last big supply shock that we got when the Russian war started in 2022. So tons of uncertainty there. We don't really know who's going to win. The sense is that there is a risk that business just shifts to the sidelines until after the election to see exactly how things are going to go before committing to a lot of investment and hiring. I think that's possibly a reasonably realistic scenario now. So with that, I'll pass on to my colleague Imre, and he's going to tell us what's going to happen to markets.
Thanks, Kelly. Sure will. Crystal ball's a bit foggy, thanks to the war. Actually, it's had one benefit. I write a morning report every morning, have done for years, and part of it is a look back on explaining what happened and why. That's not always blindingly obvious. Sometimes mysterious things happen and you can read as much as you want and you'll just never know why the dollar did or the bond yields did what they did. Last 3 months, that bit's been a piece of cake. I just look at the oil price and then I know war got better, war got worse. Easy. And then that explains why bond yields did it and why US dollar did what it did. It's been a pretty easy part of it. The hard bit then is the look ahead part of the morning report, what's going to happen tomorrow, next week. That bit's gotten completely fogged up. So yeah, pluses and minuses, but we're not going to shy away from making predictions regardless of the war. And here they go. Kiwi, in the spirit of economic scenarios, upside, downside, could do anything in the very, very near term. We'll do what the war does. But we think over time, quarter out, we've got to assume some sort of de-escalation, and that will be positive for the Kiwi dollar against the US. Essentially, it's going to be a negative for the US dollar against all currencies. Kiwi Aussie, probably ending the quarter weaker still. And for interest rates, somewhat competent forecasts, whether you're talking short-term rates or long-term rates, going higher still. And yield curve shape, for those who care, flatter still. Right, to expound on all of those things, and starting with the Kiwi US, and we always look back on the last 3 months, how do the predictions go? Astonishingly well, given we were in the middle of the war. So we did this last presentation in March, and it was really a war call. And it was, things are pretty intense at the moment. There was a lot of risk aversion. That'll hurt the Kiwi in the near term, but we're going to bank on an assumption of de-escalation by the end of the quarter. And that's kind of what we had. Yeah, the war's certainly not over. It could drag on for a long, long time, but it is not as intense as it was in the first few weeks. So that played out with huge strokes of luck. So we'll bank that one. Near term. Pretty much sideways. It's, there's no strong indication from here as to whether we escalate from this point or de-escalate from this point. The war has well and truly dominated all fundamentals in terms of driving markets, whether they're bond markets, rates markets, currency markets. Equities are kind of doing a little bit their own thing, as Kelly showed you. They're running with that strong AI theme and a fairly resilient US economy. But for rates and FX, it's really day by day just what happened in the war. So you can't throw too much science into it. Throwing a bit of technical analysis in there, I think at times like that, it is useful. You can see it's been fairly range bound, not just since the war, actually. You can go back right from about a year ago, the middle of 25. It's been largely sideways range bound. And so just extrapolating that further, it'll go on the war, but towards the end of the quarter, again, building in this assumption of perhaps a higher risk of a de-escalation than a re-escalation. It's as simple as that. And in that case, I think the Kiwi is going to end up higher. We've also got a very long-term forecast for the US dollar itself. Our house forecast it will weaken over the year ahead and even longer. 2 reasons. Number one, it's overvalued regardless of what sort of economic model you throw at it. It's overvalued, so that needs to come back to fair value. And secondly, prior to the war, there were a lot of question marks about the safe havenness of the US dollar and US investments like US treasuries. Funds were starting to reallocate slightly away from the US. We think when the war's done, that thing's going to come back onto the radar well and truly. And indeed, it'll be exacerbated somewhat by perhaps the strategies and the handling of the tactics around the war, which just kind of add a lot more negativity to the US administration. So we think that's how it will play out. Who knows when, but we'll put a late quarter ahead up arrow on it for that reason. And as for the US dollar itself, obviously it's the main driver of Kiwi US. You can see again over the last year, that thing's been in pretty much a sideways range. It has benefited from risk aversion when the war is going in an intense fashion, and when it winds down a bit, it pulls back. So, and the Kiwi's just doing the mirror image of that. One interesting little side note to bear in mind for the US dollar currency is there's a new Fed chair starting pretty soon, Kevin Warsh. He was nominated by Trump. Initially, he was seen by a Trump puppet. It's probably not going to be the case. He's got his own thoughts. Previously, he was quite a hawk. We don't know how he's going to sound when he takes office, but that's going to be one to really watch because that could well set the path of the Federal Reserve in terms of how much they might hike over the next couple of years, which will have a bearing on the currency. But that's probably a story for later on. Kiwi Aussie, how did we go last time? We called it lower. Well, okay, that worked out. And that was really, actually that was two things. The fundamentals behind it were pretty sound. Aussie economy well and truly outperforming the Kiwi economy. RBA hiking already, we're not. What else is there to see? And then you throw into the war. The war's actually benefited the Aussie more, not benefited, it's hurt the Kiwi more than it's hurt the Aussie. It's probably a better way to think about it. So again, if you've got a stronger view on the war, that's how it is going to play out. If the war de-escalates, I would guess the Kiwi could rebound for a short period. So yeah, watch out for that. But overall, we've still got those longer term fundamentals, economic performance, the RBA well ahead of us, and I think they're going to play out by the end of the quarter. Now, much, much, much longer term, if we look ahead to a year, at some point, our economy is going to recover. We're coming off a very low base. Aussie's well up there already. And so in terms of relativities, the gap's going to shrink. And that, I think, is going to benefit the Kiwi-Aussie cross. But I think that's a story really for early next year onwards. And yield spreads, very, very important part of the Kiwi-Aussie across all horizons. But we can see a glimmer of a suggestion that the yield spread, this is Kiwi minus Aussie, which is very, very low. It's at a 15-year low. So, you know, we don't often find ourselves at such a interest rate disadvantage. It is starting to turn the corner. But I think this is a story that's going to play out probably from late year and into next year. And this will be one thing that does actually help the cross next year. Okay, interest rates, short-term 2-year swap, which is a bit of a benchmark for all rates. And we call that one slightly higher and then kind of not running away too fast. And that's kind of what happened. We got up to 3.7 in the 2-year swap and just didn't go any further. The outlook from here in the very near term, i.e. month ahead, I don't think it's going to do much. I think it's going to struggle to get beyond that recent peak at 3.7. Further ahead, and by quarter end and certainly into the next quarter, we are looking at higher and higher swap rates, no question. Reason for that, Kelly's already gone through his view on the OCR, and you can see that's his projection there in red. What does the market think? The market's pretty much on board with it. In fact, for the rest of this year, till Christmas, there's no disagreement between Kelly's forecast, markets pricing, and even the Reserve Bank, which they published and updated last week. So all in line with the idea there's a tightening cycle coming. We're going to get 3 hikes before Christmas. There might be a bit of a debate about exactly which months, but 3 hikes before Christmas. Okay, that's locked in stone. Beyond that, there's a little bit of disagreement. Because we're all in agreement over the next few quarters, that's probably a good reason to think with market pricing where it is, it's about right. It's not going to run away too much from where it is now. So I don't see too much movement in swap rates over the next, say, month or two. But beyond that, we are going to get higher rates. And number one. Market pricing is still below where Kelly thinks it'll peak. If you believe Kelly, you would jump on board with the idea that's one reason why rates can rise further. Secondly, and just arithmetically, as time passes, even if that market pricing, that black curve, is the truth, then arithmetically you just shift forward in time, right? So a swap rate is just a compounded sequence of all your OCR guesses in the future. And as you can see, as you move up with time, those rates on average must get higher and higher and higher. So even if nothing changes in the market, you are going to see higher 2-year rates, 3-year rates, 5-year swap rates. They are going to rise in terms of a headline sticker. The other thing to note is that the Reserve Bank's OCR projection itself, in line till about Christmas, and then it kind of plateaus and goes out to about 3.25%. So if you took that literally, you say they think we're only going to go up to 3.25%. So why are they so low? They're always low. And I put up this chart, I think, at the last time I was here, but this is worth seeing again because we've had some updates to it. Reserve Bank always starts fairly cautiously before it enters a cycle because there's lots of uncertainty. It doesn't know. It runs with what it's got most confidence about, which is that blue line I just showed you. But in time, as it enters the tightening cycle and through it, it adjusts its OCR long-term forecast to basically end up at the final truth, which is going to be higher, right? And you can see empirically that's what always happens. Whether it's a tightening or a hiking cycle, they start off fairly conservative, fairly flattish cycle, but then it increases, and finally you get there. So the last two iterations we've had were the February MPS and the May MPS. These are the two iterations which have depicted a tightening cycle. You can see February was very, very flat, so they raised that in May. And what's going to come next? At the next MPS, almost surely another raise of those long-term OCR projections. So we're going to see higher and higher OCR projections probably from the Reserve Bank. So all of that does feed into the idea that yes, you are going to see higher and higher headline swap rates in the future. And finally, I'll finish on yield curve shape. And the reason I put this in here because we have a lot of people we talk to, borrowers, who take heed of yield curve shape to make their interest rate hedging decision. So whether they want to swap from a short-term floating rate into a longer-term rate, they like to wait for the yield curve to flatten so all the rates look the same. So, it's easy when your 1 week rate is at 5% and then your 5-year rate's at 5%. That's easy. I'll just go into a 5-year. It's the same number. So a lot of people tend to hang out and wait for a flatter and flatter curve. And yes, that will come. We've been saying that'll be coming since late last year. It always happens, as you can see, the yield curve shape moves inversely with the movement in the OCR, right? So the idea is that the short end really moves the curve shape. As you get into a tightening cycle, the short end rates go up more than the long end rates, and you get this flatter and flatter curve. So as we enter this tightening cycle and go through it, we're going to see a lot more flattening still, and we'll end up with a curve that's pretty flat, where all interest rates look the same. And they'll say, well, I should wait for that. And we say, no, empirically, that's not a good tactic, because by the time you get to that point, the outright levels of your interest rates are going to be much higher. So you got one hurting you, you got one giving you an advantage, but the one hurting you is much bigger than the one giving you the benefit, right? So you'll earn a little bit by the flatter curve, but you'll be opportunity-wise losing a lot more by the total rise in interest rates. So if you're hanging out for flatter curves to make your hedging decision, our advice would be maybe you want to just rethink that. So I'll finish on that note.